Hi, I'm Eric Jacobson with Morningstar, fixed income specialist, and we're here today in Newport Beach, California with Co-Chief Investment Officer of PIMCO, Bill Gross. Mr. Gross, thanks so much for being with us today.
Thank you, Eric. Thanks for coming.
As you know, what's on the mind of a lot of investors right now is, what are your thoughts on the policy initiatives being taken right now to address the credit crisis?
Well, they've been significant. At the moment, they haven't been necessarily effective, nor have they led to what either the Fed or the Treasury had hoped for at the moment. I mean, there's simply a lack of confidence in the market and lots of fear. And there's a technical unwinding of asset positions, whether it be in hedge funds or otherwise, that are being mandated by lower prices, leading to ultimately lower prices. What the Fed and Treasury are trying to do is to backstop that, to basically, in effect, purchase commercial paper, to, in effect, produce a $700 billion megaton type of TARP, as it's known, in terms of purchasing assets going forward, but that's a 2 or 3 week in advance type of plan, and nothing can be done at this very moment. So, the liquidity is poor in the marketplace. There's forced liquidations in terms of assets of all categories: high quality bonds, low quality bonds, stocks, obviously, as well as real estate on the hinterland, so to speak. It's not a pretty picture.
So you took us right up to this point here. If you could, give us a little bit of a thumbnail about how we should think about the process of the acquisition of the assets and what it's going to mean in terms of the government either losing money, making money. I know you've got some pretty strong opinions on that.
Right. I think the government has been allowed, through this 500-page omnibus bill, considerable flexibility in terms of what they either want to do or need to do. The original intention was to purchase subprime mortgages, and indeed I think they'll proceed with that. But they also have the flexibility to buy bank capital, to in effect buy preferred stocks of banks, which at the moment is what the UK and the Bank of England and perhaps other countries in Euroland are about to do. That would be a more effective way of injecting capital straight into the heart of the system. Remember that banks can take capital and multiply it by a ratio of about 10 to 1. Doesn't mean they're going to, and at the moment they're not willing lenders, but to think that the Treasury can, yes, buy subprime mortgages and that will help unclog the pipes and the plumbing, so to speak, but also to potentially buy preferred stock, which is a capital injection of the purest form, which would then allow for additional lending. So I think the combination of the two efforts and lots of other things that could or might be done, I think is very important.
If I could, one last quick question. What do you think we should expect investors, just regular working people, et cetera, in terms of the economic outlook for the next few years and maybe a little farther beyond?
Well, the financial system's delevering, much like it levered up for the last 20 to 30 years. Much of our prosperity was based upon asset appreciation and additional leverage, and now that the system is delevering and asset prices are coming down, the economy moves in reverse. I think ultimately, the economy, the global economy, should recover. Let's not go overboard, but I think we're looking at a period of time, whether it's 12 months, 24 months of significant recession and ultimately high unemployment and low levels of profits. It's not a fortuitous scenario, despite the efforts that are being made by the Treasury and the Fed.
Well, it's good to hear that you didn't use the D word that I think everybody's worried about. I really appreciate you speaking with us today, and that's it for us here at PIMCO in Newport Beach. Thank you very much.
Thank you, Eric.